Uh-oh. On. There he is. There I am. What's going on, everybody? It's James Hollingsworth, the Working People's podcast, where everybody desires to build generational wealth and a financial legacy for their families. And before we get going on something that I had told you I was probably going to bring to you, which I am right now, we're going to check audio. Let's check audio. We have audio and we're live right here on James Hollingsworth Facebook page. And we're also live on the U of the Tube. YouTube streaming live. Once again, it's your host of the Working People's Podcast, James Hollingsworth, where everybody desires to build generational wealth and a financial legacy for their families. So let me pull up this. So if you saw, I posted the other day on my Facebook page, I posted and said, let me read it to you. I said, let me find it. Here it is. I said, man, I need to do a video literally showing the numbers on rates of return and use a risk factor analysis that will consider 7 metrics to literally show that price and greater cost does not equal greater rates of return. And yes, if you do not properly analyze and manage your risk, your rate of return will not be greater simply because your investment had a higher price and cost more. You must see these 7 components as having inherent risk factors that must be managed accordingly, both individually and collectively. And that is time, capacity, volume, volatility, economic climates, market risk, net income / profitability, which may include both growth and dividends, rates of return, and that does factor into your rates of return. And then number 7, asset classes or portfolio allocation. We'll look at that in a little bit. And then the numbers can be easily calculated. And if we consider these 3 things being equal, and I'll show you that here in the numbers, to show an equitable comparison, which is the amount being invested. Number 2, the rate of return. Number 3, time. Those things being equal. However, I'm not even going to show you the comparison of if they were equal or if they were not equal in terms of the actual rate of return. So let's really get into it, because here's kind of where this came from. Now, first of all, we must give you the disclosure and tell you, I'm not telling you to invest in any particular stock, ETF, mutual fund, investment, or anything based on the examples we're going to use. This is for educational purposes, right? So I'm not telling you to invest in any of these particular stocks, investments, nothing, right? I'm not telling you or discouraging you to invest or not to invest. And as well as I am not telling you not to invest in Bitcoin or cryptocurrency, but I am going to give you an analysis to show you that unlike what some people think, that Bitcoin is the fastest growing asset class in the world or in America or whatever, I'm going to actually show you the actual numbers. We're going to do them on the screen to show you that if you don't take a pen and a piece of paper, one of my early mentors, James Green, said, he said a short pen is better than a long memory. And even a short pen is better than a hypothesis that you haven't really ran the numbers on. So I am not telling you don't invest in Bitcoin, don't invest in crypto. I'm not telling you that. I'm not telling you to invest in it, but I am going to debunk the assertion, right, that because the price is higher and there's more volatility, of course, and because the investment costs more, that's simply because of that. And we see this staggering number out there, and we see a 30% return or whatever we see year to date, which we're going to look at those numbers. That doesn't automatically mean that it's a faster growing asset, or that it's a more profitable asset, or that it is a more profitable investment in terms of its rate of return. And so I like looking at numbers. I don't like making, I just don't. I don't like making assumptions or assertions without taking a pen, or in this case, a computer, and actually calculating the data, running the numbers, and see what the real deal is. Because if you want to lose your shirt, your shoes, you want your hairline to start receding, and you want your, yeah, where you can't afford baby diapers or nothing else, and you're literally losing your shirt, shoes, and your drawers, invest to number one with just pure emotions. And number two, invest without really doing your due diligence, just making assertions or assumptions based on your feelings about what you see with your naked eye. The numbers don't lie. I should become a rapper. What you see with your naked eye may be a lie, but the numbers don't lie. So we're going to run through the numbers. So first of all, let's take a look here, and I will share my screen with you at the presentation where we have literally ran the numbers on three particular stocks. Like I say, disclosure is I'm not telling you to invest or not invest or whatever. I'm not. It's for educational purpose or over to show the illustration of actually running the real numbers and running the data. And we got the numbers on Bitcoin from, I believe, the 12th. So here we go. And if you come through, drop some comments and also give us a thumbs up like on the video. So here we go. Running the numbers. Not trying to bore you, but if you really want to be a decent and have some success long-term investing, you got to take the time to run the numbers. Come on, man. You feel me? All right, here we go. Let's share the screen. Oh, yeah. Let's pull up the presentation. As you see on the screen, this is James Hollingsworth, and we are doing a presentation today, June the 4th. I said June the 4th. Help me. It's not June the 4th. Let me change that. It's July. Oh, my goodness. July 14th. There we go. Let's save that. Let's put it on this one, too. It is July the 14th. I didn't change the date. There you go. So let's save that. Now we got the right date. Let's pull it up. Here we go. All right. So the Working People's Podcast, today is July the 14th, 2024. So let's look at this and let's examine it for what it truly is. All right. We're talking about risk factors. Every investment has risk associated with it. And what we want to try to do is take as much of that risk and either minimize it. And a lot of times how you minimize it is by transferring it to somewhere else, whether you do it through leverage, whether you do it by having a low burn rate and a high level of liquidity or cash flow, something like that, just as a couple of examples. Or transfer, like I say, transferring that risk to something else, like another asset, or transferring it to someone else to insure or to collateralize it, or however you want to do it. But the risk is going to always be there. It's just, how do you manage that risk, and how much risk are you able to take on, as well as how much risk do you have the tolerance to handle yourself with your own individual investment style, your mindset about investing, your perception, your viewpoints, and all of that about investing. So with that in mind, time in itself is a risk factor. And how much of it do you have, and how much of it do you need? Now, it is always best to start investing. Susie Orman talks about it. If you're 20 years old, you can invest $100 a month. And you do that, and I think the numbers are ran on like an 8% or a 9% return. You can actually accumulate, if you average that over 40, 45, however many years, you can actually accumulate $1 million in investments. Yes, you can if you're young because you got a lot of time. So how much of it do you have? Now, if you're older, time is not as much of your friend as it is to a 20-year-old, as well as now it creates more risk the older you are, because now you either need a higher rate of return to accomplish the same thing that a young person would need with a lower rate of return and more time. So you would need a higher rate of return. Thus, you would incur more and a higher rate of risk by doing that, because time in itself, it either is going to be a factor where it lowers your risk or it increases your risk based on how much of it do you have in your investment horizon and how much time do you need to reach your particular goal. You may have a short-term goal that only requires that you need 5 years. Well, in that case, it doesn't matter if you're 20 years old, 50 years old, or 70 years old. If your time horizon, say, is 5 years or whatever that case may be, then all things being equal, it doesn't matter what your age is, right? So that will determine how much risk you're going to actually take on. So if you look at it, what are the number of periods that you need to compound to reach your forecasted rate of return? So in other words, if you are earning an average over time, whatever that time is, of 15%, your money will double according to the rule of 72s. It will double every 4.8 years. If you average 12%, a 12% return, annualized over a certain period of time, then your money will double every 6 years. That gives you an example, right? So with that in mind, are you trying to get there fast because you do not have as much time? Then, like we said before, if that's the case, then you're going to increase or incur a greater amount of risk, right? And that's one of the things that causes people to have, here's the emotional part. There's a level of anxiety comes as the numbers increase, the amount of money that you're investing increases. There's also amount of emotional stress and anxiety that comes, as well as if you see, if you're trying to get somewhere fast and you're trying to be more aggressive, and therefore you're increasing your, or at least you're trying to obtain a higher rate of return. So now you're incurring a lot more risk. Well, the anxiety and emotional anxiety part is going to kick in, and it's going to affect your emotional ability and your view to be able to take the emotional aspect out of it, look at things objectively, and make sure that you're investing according to your strategy. So therefore, we always say we trade with the charts and not our hearts. We got to take the emotional aspect out of it so that we can see clearly, and it doesn't bring a level of anxiety as we're investing that causes us to make decisions. I won't say hastily, but it certainly will influence our clarity in making those decisions. And it can skew, not the numbers, but it can skew our perception of the data that we're seeing and how we're analyzing that data. Number 3, can you determine the size of your shovel? Time can determine the size of your shovel needed to reach your goal. So if you have more time, you don't need as big of a shovel. And I'm talking about income, right? Earnings or some level of cash flow. So if you got a lot of time and you do have a big shovel, man, you can really create a lot of volume. Number 4, you have to take it on substantially more risk. So the less amount of time that you have to take on a substantially more amount of risk. Number 5, time, if managed efficiently and maximized, it can in itself inherently lower your risk. And that is the truth. All right. So one thing that we want to look at that I talked about was capacity. So let's think about capacity. Let's look at this. All right. And what I'm going to do here real quick is, booyah, right there. There we go. All right. We've made the video public. So when we're looking at capacity, let's look at the definition of capacity. The definition of capacity is the financial capacity. It is the financial limit of a person's ability to absorb losses. This is huge, people. A lot of times when we do look at risk, we only look at risk tolerance, and we forget about just as much of an important factor as risk tolerance. How much risk can you handle is how much risk emotionally, but how much risk is your finances set up in a way where you could take on a greater capacity of risk, right? So it's the financial limit of a person's ability to absorb losses with its own funds or borrowed funds without any major disruptions. Because if you don't have a higher capacity of risk, say you've taken on a lot of debt and you don't have sufficient cash flow and you're leaning on, instead of equity, instead of liquidity, you're leaning on equity and a leveraged asset, and how much equity is in that leveraged asset in order to float yourself over time until you're able to increase your cash flow. And I know I'm talking kind of fast, but if you run a system like that and you get caught in the economic cycle, then your capacity to handle any type of major financial disruptions is low. All right. And the losses can be devastating, especially if you have to sell the asset, right? And or the asset is underwater because the amount that is owed on the loan is greater than the amount of that you have in equity or the actual market value of the asset itself. So that can catch you. Flip that. Sorry. So that can catch you in a place where you can have a major financial disruption. Or if something happens in your cash flow, it's 40%. So you got to make sure you keep your margins in place so your capacity can remain high, so that if something does happen, an economic cycle, a downturn in certain market sectors, or you run into, like I say, a reduction or in your cash flow, or there's a cycle in the market that there certain sectors might pull back, right? Or consolidation of gains may happen for a few days or a week. Are you able to ride those times out, right? And are you able to make sure that as you're riding those times out, that your cash flow and that you have enough liquidity to leverage that cash flow and enough liquidity to leverage the actual loan itself, rather than relying totally on just the equity in that asset that's leveraged by that's being leveraged against the loan. So examples of that would be not getting, like I mentioned, over leverage, where your cash flow or your investment plan or your strategy gets disrupted due to an economic or financial situation that forces you to alter your plan. That can be devastating when you are forced to alter your plan because of a financial situation or an economic climate change. And then I've seen where people have, when you get caught in the cycle, they have to sell their investments at a loss, during unfavorable times, or you don't have enough cash flow to cover your expenses. Then you have reduced savings or your investment rate. All of a sudden something changes there, or you have to borrow more money than what you had initially planned to borrow. Now you just raised your debt to income ratio, and you just drastically disrupted your level of cash flow, and then you increased your burn rate. All right. So the truth is, the reason why so many people's plans are flawed and they fail is because, have they really examined what is their purpose for wanting to do this, right? What is their why? What are their goals? Are the goals unclear? Because when your goals are not clear and you haven't just done, like I said, where's my pen? I don't know what I did with my pen. Oh my goodness. I could get one, but whatever. You get the point, right? They haven't sat down with a pen and determined, is this a viable plan, right? Are my goals clear? What is my purpose? Why do I want to accomplish this particular goal, right? And so that brings if it's unclear, and those goals and those whys and things and the purpose has not been clearly defined, measured, and strategized, then that's when a lot of people run into bumps, hiccups, and setbacks that shows major flaws in their plan. And actually it can cause a point of stress. When you don't stress test the plan, it can cause a failure to the plan. All righty. So let's dive deep Hey, here we go. Are you ready? Let's dive deep into the numbers. I got to bring myself back on screen real quick because I want you to really get this. If you got to get a pen and a piece of paper and write these numbers down, or go back later and watch this video again and really examine these numbers, study them and go through them yourself so you can see exactly what we're talking about. So once again, the premise that a lot of people think is, oh, look at the price of Bitcoin. Man, if that thing goes up 30%, you're going to make a fortune, right? Because look at the price. Look how high it is. Look how much it costs. Surely, if it costs that much, you're going to make more money, right, off of it compared to just a regular old stock. Because surely Bitcoin and cryptocurrency is the most aggressive and the most highest. It is the most profitable, money-making investment in the world right now. Surely that is. But I'm going to show you, all things being equal, the amount being invested, time, and rates of return, even if they're close, especially if they are the same. I'm going to show you that that's not necessarily the case. And actually, it's not the case. So we're going to run the real actual data, the numbers, and show you what the real deal is. And then compare that to what we talked about, the risk factors, time, capacity, volatility, and some other risk factors, and determine if you have such high risk factors, is that really going to give you a greater rate of return? Especially when we factor in the number one thing that is the most important element that we often do not talk about when we talk about investing, and that is the human element of human behavior. Here we go. I love this. This is freaking awesome, man. All right, back on the screen. Here we go. Okay, Bitcoin. This data is from July the 12th, right? I took the data from Bitcoin, Chipotle, and a couple other stocks from July the 12th, and I did the year-to-date returns from January until July the 12th, year-to-date. So year-to-date from January the 1st to July the 12th, 2024, Bitcoin was at $57,626.40. It was up year-to-date 30.36% at that particular time, 125 on July 12th. All right, 30.36%. Next to it, we have Chipotle, who just did a 10-for-1 split. Woo! Give it up, y'all. Chipotle on July the 12th was up year-to-date 28.17%. So let's run the numbers. Here's the numbers. $5,000 invested in both Bitcoin, $5,000 invested in Chipotle, right? All things being equal. We're going to run this based on their actual year-to-date returns. 30.36 for Bitcoin. And then what was it? 28.17 for Chipotle. We're going to run it with the actual numbers first. All right. And let's see what our rates of return and our return on our investment was. $5,000 year to date, 30.36. Number of shares, how many will it buy at the $5,000? Based on that share price, or that price of $57,626.40. $5,000, you divide it into that number, comes up with 0.08676. That's your number of shares that you got with your $5,000 investment. Now, if you take that 57,626.40, right, and you multiply times the year-to-date and return rate of return of 30.36, it comes to $17,495.37 increase over the $57,000 price. So you add those two together, the 57,626.40 plus that 17,495.37, which is your 30.36% rate of return, it gives you 75,121.77. So if Bitcoin from that date, July the 12th, still held steady next 6 months, came in at the same 30.36 rate of return based on that 57,626.40 amount, the amount that it would have went up was the 17,495.37. So you add those together, that would put Bitcoin at a price, if that would happen, of 75,121.77 cents. Now you take your number of shares, which was the 0.08676, you multiply it times the price that it increased to based on that 30.36 rate of return, which was the 75,121.77. It gives you a profit. Well, it gives you an amount that now your shares are worth, that you initially bought 5,000. It is now your investment is now worth $6,517.56. If you take that $6,517.56 and you take out your original $5,000 deduction, your profit, net profit on that would be $1,517.56. All right, you got it? $1,517.56. That was your profit off of an investment that you put 5,000 in, Bitcoin in this case, and the price was 57,626.40. You had a rate of return of 30.36, and there you go, $1,517.56. All right. So now let's look at Chipotle. Chipotle, the same $5,000 investment. Year to date, we saw that their year to date rate of return was 28.17. All right, 28.17. If you take the $5,000 investment at the share price of $57.55 after the split, right, and they were at $57.55, you invested at that amount, right, $5,000, it would have got you 86.8809 shares. All right, so you take that 57.55, the amount of share, the cost of shares on July 12th, and you multiply it times the rate of return, 28.17, right? And it gives you an increase of $16.21. Now you take that 57.55 and you add the increase of 16.21, which was your amount of rate of return based on your 28.17 year to date, and then you get a stock price of 73.76, right? So now you take your number of shares, 86.8809, multiply that time your shares, share price, your new share price, based on your 28.17 rate of return, 73.76, and that equals $6,408.33. That is the market value of your now investment with your 28.17 rate of return. You take that $6,408.33 and you extract out of it minus your original $5,000 investment, you have a $1,408.33 profit. So you see Bitcoin at the 30.36 return year to date, and Chipotle at the 28.17, slightly lower rate of return. You can see the difference in the price of your profit, amount of your profit. And let's do the math on it. Let's get in here to a calculator, give you the exact dollar amount. All righty. Calculator, it was $1,517.56. And if you take out this amount that Chipotle came in at, the 1,000 minus $1,408.33, you would have made $109.23 more on the Bitcoin investment, right? At those rates of return. However, we talked about volatility. So let's come out of here for a hot second. We talked about volatility. The volatility of Bitcoin versus the volatility of Chipotle. And I believe Chipotle pays a dividend. Let's see. Let's see here. Does Chipotle pay dividends? So Chipotle does not pay a dividend, right? It pours all of its profits back into the business, And so you get the price appreciation. So all things being equal, you don't get dividends off of either the Bitcoin or the you just get the appreciation of growth or Chipotle or Bitcoin. But the volatility, I don't know where you can find a beta on Bitcoin to assess what its true volatility ranking is. You can go and get the beta for Chipotle and see what their volatility is. And I can tell you right now, the volatility is nowhere near the level of volatility of Bitcoin and cryptocurrency. So for this huge amount of increased risk, you only made an extra $109 and what we say 23 cents for a huge amount of more volatility. And let's keep it real. Let's be truthful. If we're saying all things are equal, $5,000 investment in both, right? You can see the the rates of return and the amount that you made off the investment, because the amount that you invested was exactly the same, right? And the time frame is exactly the same year to date. That the rates of return in terms of how much money you made was comparable, was actually parallel. But what changes the factors is the risk. In this case, we're talking about volatility as one of the huge big risk factors, right? As well as you got an increase of market risk. Also, you have portfolio risk because you can't hedge it, right? How do you hedge your Bitcoin? Are you going to hedge it with gold? No. Right? So what are you going to hedge it with? More cryptocurrency? Probably not, because of the level of volatility. You need a stable asset to hedge. You can hedge it with liquidity, but because of the level of volatility that we're talking about, you don't know how long that cycle might last if there is a correction or a cyclical downturn, right, where you have to ride yourself out. So thus, it increases your, or it actually substantially lowers your risk capacity, even though you may have a high risk tolerance, right? Your actual capacity of risk is lowered because of the level of volatility of the asset class. All right, so let's do a look at it. If, let's say, Chipotle came in at the exact 30.36, right, rate of return, you're going to see, all things being equal, rates of return, the amount being invested, and the time horizon. Let's look at it, show you the real numbers so you can see it for yourself, right? Let's do it on the hypothetical exact 30.36 year-to-date return. You run those numbers, you still get the same 86.8809 number of shares, right? However, because of the share price 57.55, at the new rate of return, the hypothetical one being exactly like the rate of return year to date of Bitcoin, 30.36, you now have 1747. That is your increase, 57.55 plus your 1747 based on your 30.36 rate of return gives you 7502. You take that 7502 and you do your multiplication on it with your number of shares, comes out to $6,517.80. That is your market value. You take that market value of $6,517.80, extract or remove your initial $5,000 investment. You have a net profit based on the same exact rate of return of 30.36 of Bitcoin of $1,517.80. So you have a difference of 24 cents. You made 24 cents more on the Chipotle at the same exact 30.36 year-to-date return over Bitcoin without the level of volatility, without the exposure to a high degree of market risk, and without substantially lowering your risk capacity and not being able to have suitable ways to hedge that that asset in terms of the Bitcoin assets, right? So you're taking on a huge amount more risk to get the same, the same profit margins on the same returns, right? So you can make the assumptions and say, well, what if you put in more into Bitcoin? It doesn't change your risk factors. That's the whole point. You don't change your risk factors just because you might dollar cost average less or more. Those same levels of volatility still exist. That doesn't change, right? So do you want to take on that much more risk, lower your risk capacity, and take on a higher degree of volatility to get the same degree of return? So let's look at a couple of other investments in particular. There we go. Sorry. Let's look at this. Microsoft, NVIDIA. Microsoft came in at the same July 12th date at 22.02, right? Year to date. And NVIDIA came in at 167.32 rate of return. Is NVIDIA a higher risk factor investment than Bitcoin? Does it have a higher degree of volatility? Well, you can pull up the beta. Let's see if I can find the beta on NVIDIA. Let's see here. Let's see if I can find the beta on NVIDIA, if it will give me the beta. Where is the beta? I might have to just ask it for the beta. Fundamentals. Okay. Let's do it this way. Let's try this, folks. So let's go NVIDIA BETA. Let's just ask it for the beta. Okay. So as of July 14th, 2024, NVIDIA's corporation's beta was 1.74. If you have a beta of 1, that means the risk or the volatility of it is equal to the actual indexes of the market. So you can see it's less than 2, so it's a 1.74. So it is slightly more volatile than the market, right? But I can guarantee you that 1.74 beta on NVIDIA is nowhere near the level of volatility on the Bitcoin. As well as if you Google Bitcoin, you have no idea who owns it. Nobody ships you up some Bitcoin in the mail and you get it in the mail and you put it in the safe. Yeah, you got it hidden in some kind of, vault somewhere out in the clouds or wherever you put it, right? But at the same time, when you're investing in NVIDIA, Microsoft, Apple, you're investing in Chipotle, you're actually owning shares of the company. And you get your little, your little packet in the mail saying you, as a shareholder, you can vote on things that they have, that shareholders can vote on. You actually own a part of the company. And you can go down to Chipotle and get you a little Chipotle bowl with some steak and chicken and lettuce and tomatoes and beans in it, right? NVIDIA, you can look at your computer, you can see the chips, right? The processing units, chips or whatever in your computer. It is a real legitimate company. They have full disclosure on their balance sheets. They have their SEC filings, right? They also have their public company, so they release what the earnings reports are, right, publicly. You can look up, who owns these companies. NVIDIA, who owns and started Microsoft. We know who owned and started Microsoft, right? Same with Apple. You know who the owners are. You can look at the owner's reputation, the character, performance, because when we're buying a company, we're buying leadership, right? We're buying more than just the asset itself. We're buying shares in the company. We have ownership in that company, right? And we share in the growth of sales and the growth of profits, and we share in the growth of that company. And some companies pay dividends, so they return a portion of those profits back to the shareholders in the form of dividends. And so I just think, for me personally, it is more of a viable investment to go with something where I can hedge it if I need. You can get options on different stocks. You can, like I say, all those things, and none of those things with the level of risk factors that you're looking at, with the level of risk that you have to take on. I just don't feel comfortable personally myself, as you've probably determined in this little presentation, why I would want to take on that much risk with Bitcoin when I can get the same return on a on a less riskier investment. It's just that simple. So an evaluation and assessment, as we begin to wrap this up, is the amount being invested. We talked about that, right? And truth be told, when you're dollar cost averaging, people, human behavior, we talked about the human behavior and that human element. When they see a lower price, they tend to be okay with investing more, even if they're dollar cost averaging, because they see a price that seems to be more of with a less barrier of entrance, right? You see a stock price like 57.55. Well, I mean, you saw with a $5,000 investment, you came up with 86 shares. So it will give the human behavior aspect tends people to tend to be more comfortable with actually investing more as they see a price that seems to be more accessible and reachable. When you tend to see a higher price, people tend to nickel and dime and just throw $10 in there, $5 in there, $25 in there, $100 in there, right? And then they know that there's a higher level of volatility. So you got that human behavior factor in there. And so all things being equal, are you really going to see those two things being equal, the amounts being invested? In my experience, typically no. You're going to see a higher level of investment and dollars being allocated toward the investment that costs less, because the human mind and human you're telling yourself, wow, I'm buying a lot more shares, which is why what makes attractive to a lot of people, penny stocks become attractive to people, because they're thinking, wow, if I took $5,000, I can buy 1 million shares of this penny stock, right? And just having more, the human behavior aspect of that makes us feel like we're getting more value for our dollars. So if you're going to really say all things being equal, typically the person who is dollar cost averaging into a stock with less volatility, lower stock price, and those types of things, they typically will invest more than the person that's investing in the riskier asset. That's just the psychology of the investment and the human aspect of human behavior when it comes to investing. The rates of return, we already talked about that. The level of volatility that you would take on to get the same type of rate of return based on the amount that you're investing. I mean, is it really worth it to take on that much risk, right? And then the time factor involved. Most of the time factors are going to be pretty equal and standard as well. And so what often happens is people will see an asset like Bitcoin and see it as something that I can make more money off of. So now they're taking on a lot more risk and they're trying to make a lot of money in a short period of time, literally trying to get rich overnight. And like I said, if you really want to expose yourself and potentially risk losing your shirt, shoes, and your drawers and your underwear, that's not the way to play the game. All right. So now we got those factors like we talked about a lot. Volatility. You can manage through macroeconomic evaluations, through having more of a ability to do your due diligence in your research components. When you're looking at the actual data sheets and the actual performance data, the earnings reports, the SEC filings, all of those documents that are accessible and available to you, you can more macroeconomically evaluate that data and be able to kind of come up with a strategy to manage your economic climate risk, your cycle risk, and your market risk, right? So then you can also do portfolio analysis, or allocations, through looking at what sectors you can put. Like if you're going to put together just a pure stock portfolio, you might want to put together 20 or 30 stocks, and you can set those allocations up based on sectors and international growth stocks, dividend stocks. You can build out a portfolio, and in that portfolio allocation, that also is a risk management strategy, because through diversification, you can spread out your risk. Thus, you can you can raise your risk capacity, like lower your risk factors through both the dollar cost averaging and both the diversification of the allocation of the portfolio. So that can actually be a great risk management strategy. You can't really do that with Bitcoin because it's all the same asset class, right? The capacity, we talked about that a lot. And then the volume aspect. You can potentially, because of the human element factor, people tend to build up a higher volume in something that costs less because they believe that their value is in getting more for their dollars. All right. So what is your why? Why do you want to take on more risk? And why do you feel inherently, without running the numbers, that you're making more off of an asset that costs more, that has more volatility, when we've just ran the numbers and showed you, all things being equal, and even with a lower rate of return on the Bitcoin, not the Bitcoin, but on the Chipotle over the Bitcoin, there was only $109 difference in the amount of money that you made with the same $5,000 investment. But the risk factors, you feel me what I'm saying? So that's the ideal, right? So if you think about it, what is your why? Why do you want to take on that much risk? All righty. So let's also look at, let's see here. All righty. When you look at your why, sorry, I'm just looking at see where we are with the, if there was any comments or anything. If you look at your why, you really have to determine, why do you want to take on that much risk? And that really makes sense when you do the numbers and you run the actual numbers. All righty. Let's come out of here. So as we've done this analysis, looking at the risk factors relative to your rates of return, I would suggest to you, whatever you're going to invest in, sit down and do your numbers. Run your numbers. And I don't know why this thing is not updating. But sit down and run your numbers and actually see what your projected rate of returns, what you're trying to achieve with your rate of returns, right? So now if you're forecasting for future, right, you can't take past performance, even though the disclosure is past performance is not a guarantee of future success or future performance. We know that. But if you want to use it as a benchmark to project out what your rates of return, what you're trying to accomplish in terms of, your profits, then you can run the real numbers and see, right? And come up with a strategy and a plan. Don't just haphazardly invest without doing your due diligence. Come on now. It makes no sense to expose yourself to that type of market risk, without doing the due diligence and running the numbers. And it's a simple thing of taking out a calculator, a pen, a piece of paper, and writing it down and seeing what the actual real data says and the numbers truly are. So this has been James Hollingsworth. I've been your host today on the Working People's Podcast. I think we've been on for about, 50 minutes or so. I think we're under an hour still. I didn't really look to see what time we went live, but I've been streaming live to my personal Facebook page, and you of the tube, if you're over there on YouTube and you want to go ahead and subscribe to the channel, we would love to have you subscribe, drop some comments. I'll go over there, check it out, as well as you can on YouTube, you can subscribe, you can press that thumbs up like button and engage, in some comments. And over here, do the same. You come through, watch the video, give us some hearts, some thumbs up, drop some comments. If you have any questions, many of you could know that you can, get me through my DM or something like that. If you got my phone number, those of you that know me, call me up and ask me to give you more clarity in terms of this numbers, the data that we just ran the numbers on. So James Hollingsworth, once again, your host on the Working People's Podcast, where everybody desires to build generational wealth and a financial legacy for the family. But I got to go, and I hope you enjoyed this analysis and presentation today. So I'll see you next time.